Okay, so welcome to this short tutorial about how to manage debits and credits. I'm doing this because it's the basic language to understand accounting, and I highly recommend you that with everything you do in accounting, you think of it in terms of debits and credits. It's going to help you a lot to understand the transactions and to find mistakes. So we're gonna do this by doing some examples. I'm gonna start with an example, and then I have a voluntary here. So I'm gonna ask him to do some exercises too to see if it's clear. So the general idea is that debit increases assets and expenses, and it decreases liabilities, equity, and revenue, whereas credit decreases assets and decreases expenses, and it increases liabilities, equity, and revenue. So that also means that normally the assets and expenses are going to have debit balances. If they would have credit balances, that would be negative assets and negative expenses, which is strange. And liabilities, equity, and revenue are normally credit, have a credit total, because if they would be debit, again, that would mean that they would be negative. So let's start. The one recommendation I have for everybody is always start with the easiest entry, which is usually cash. So the first example I want to do is that the company is paying some salaries. So we have cash that goes out. If it's going out, it means it's credit, 100. And then there's the debit side would be an expense. Salaries of the same 100. So if we write that down, it's debit salaries is 100 and credit bank 100. So you always write first the debit and then the credit. That's just a convention. So let me entertain now my guest. We buy an inventory, but we don't pay for it. So it arrives at our warehouse. We buy it for 200, but we haven't paid for it. What do you think we should do?
Assets.
Assets what? Debit or credit?
Debit.
Okay. PP&E or
Inventory.
Inventory. Okay.
Goes up to 200.
200. Okay.
Is account payable.
An account payable.
Credit 200.
Yeah, that makes sense because it's a debt, right? So liabilities goes up, accounts payable for 200, and then what I purchase is an inventory. It goes up by 200. Now we're gonna sell that inventory. We're gonna sell it for cash, right? We're gonna sell it for 300. So now some different things at the same time are gonna move. So you can start however you want to.
Okay, so inventory goes out.
First, you know that the inventory is leaving our place.
And your cost of goods sold, it's 200. So expenses are 200.
Cost of sales of goods sold.
The COGS.
The COGS, yes. Thanks for repeating that nice word. That's 200. So I'm gonna write it down. Cost of goods sold 200. No, that yes. And credit inventory 200.
And now we would collect the cash, or
Yes.
we have an accounts receivable.
We collect in cash.
Okay, so cash goes
Yes. Cash goes up. We sold it for 300, so
Okay,
debit
300.
300.
And
I'm recording. Yes.
and
So we have a debit.
collected.
Recording.
I saw at least one or two mistakes over there.
300.
300. Paul. Okay, so I'm gonna note that down too. That's debit cash 300 and credit revenue 300. Okay, now we're being sued. It's probably an American company for $1,000 billion. So what should we do with that?
We need to create a provision.
Yes. Okay, this was there from the last time. Provision. The provision goes up, right? So
Yeah.
that's debit or credit. Correct. Okay, 1,000. I'm gonna write that down here. Provision. Now, what are your options? What do you think?
It's an expense. You debit.
Okay. For lawsuit
Provision.
expense 1,000.
You cannot do it on your assets because you're actually not decreasing the ability to generate profit out of them. So it's an expense.
Okay. Actually, there's a possibility in case you make some provisions. For example, if mining companies, they make provisions for the future costs they're gonna have to leave the land the way they found it. You can capitalize it, and actually a big dilemma in accounting many times is whether you do debit assets or debit expense. So the companies are gonna want to show assets, whereas auditors will argue in favor of expenses, which is more conservative. Now the shareholders are gonna give us 800 in cash.
Okay.
How should we account for that?
We have to debit assets, cash 800.
Okay, that's 5 cash. It's coming in, so it's a debit. How much did we say? 800. Okay.
And owner's equity goes
Okay.
up, so credit.
This is a capital credit
800.
Perfect. So that's cash. We're receiving 800 and capital equity also 800. Okay, we already have a lawsuit. And finally, at the end of the year, we want assets to be equal to liabilities plus equity. We see that's not the case. We see we have 1,000 of assets, total assets, and 2,000 of total equity plus liabilities. That's because we haven't closed the income statement. Let's see what went wrong here. We didn't do the totals. So we're gonna close the income statement by seeing. So the net of this is we have 1,300 of debits, 300 of credits. So we have a difference of thousands, which we are gonna do this way. Closing P&L, I'm gonna call it 1,000, and this is gonna end up in retained earnings 1,000. Okay, so here we actually see first of all that the balance sheet is balanced, and we see that the account of retained earnings is where every year's P&L goes accumulating. So if you had losses, retained earnings goes down, which happened in this case through a debit entry. If you have a profit, retained earnings goes up. So this is the basics I wanted to share with you. Remember, start with the easy entry, which is usually cash, and always in everything we talk about in accounting, always think in terms of debit and credit.